Wealth management is way more than simply managing money. We work together with estate planners, CPA firms, insurance brokers, and so on to create a totality that works for the long-term needs of the client.
I joined my father's firm in 2006, and we realized together that we could add a lot of value, especially as compared to our peers who didn't have the context or training of a tax advisor.
We're in the world of data-driven, evidence-driven investing. We are really counter-cyclical educators. When the market's going up incredibly strongly, we keep cautioning people to the fact that these things don't go up in straight lines forever. And when the market's doing poorly, we inform them, advise them that markets don't go down forever either.
Having the privilege of working with my father brings a lot to the table. We have all of his experience and gray hair, as well as the energy and enthusiasm of the next generation.
We view ourselves as kind of the quarterback of a financial planning team. Our primary role is to design and implement a portfolio that's responsive to the total financial situation of each client.
Taxes are the largest bills that most of us will pay on an annual basis. And if we can do anything to help minimize or reduce that expense, whether it's inside the portfolio we're managing or within the client's overall picture, we've achieved a lot.
Everybody in our firm really loves what we do. The emails fly at all times of the night, and from early in the morning they start. And you can sense the passion in every meeting, in every client interchange, and in the roundtable conversations that we have with our own group at the office.
Proudly having been in business and active through the 2008 collapse, I can tell you that our counsel and approach with our clients does work. We encourage and educate our clients to stay buckled in, to remain committed through the ups and the downs.
So RVW has really taken on a life of its own today, fulfilling the original idea of low costs, tax efficiency, and no conflicts of interest.
It's extremely rewarding when our clients achieve their goals, whether it's a gift to charity or a transfer of wealth to the next generation. That's why we do what we do.
Hello, everyone, and welcome to our RVW Wealth Webcast. It is great to see everyone who have signed in from around the world. Today, we are very excited to have Dr. Elliot Hentov with us to discuss the impact of COVID and the U.S. elections. Elliot, thank you for joining us.
Stephen, thank you for having me. Pleasure to be here.
Great. And Elliot's role is unique in a few ways. As the head of global macro policy and research team, his job requires him to look at long-term thematic trends that evolve over months and years. And this means constantly interfacing with global institutions, central bankers, sovereign wealth funds, and more. And ultimately, the goal is to understand how this fiscal and monetary policy will interact with capital markets. And also, Elliot's a frequent guest on Bloomberg, CNBC, and a lot of the other media outlets you might see in order to share this research with investors. So great. Thank you for having us.
Pleasure to be here.
Great. So please kick it off.
Okay. Well, thank you. Basically, I was asked, well, how should we think about the short-term news flow and link it with some of the longer-term structural trends that we see in the marketplace? And as Stephen mentioned in the outset, the idea is, for my role is to spot where policy links with financial markets and the real economy. I think the first question is, I think, we're still in the midst of the pandemic, although thankfully, I think we're well past the midpoint. When the pandemic started, I think the overwhelming mental challenge for all of us was to think through, how does this crisis operate? I think we all recall the early days in March when things were shutting down and governments were ramping up policy support programs. And obviously our investors as clients and ourselves were wondering to what degree the markets would be able to digest the shock of the pandemic. And you recall perhaps that the market low point of the pandemic was reached fairly quickly. If you I think in Europe it was about, or in the UK, it was about a week into, it was actually the day of the first official lockdown, a week into the pandemic raging, where you actually hit the low point of the market, and then the very rapid ascent and recovery began as markets started to price in future government support as well as the impact of the cost. But I don't want to recap what has happened in the last few months, but really try to help you think through what will stay with us when the pandemic's actually over, not only in 2021, but also in 2022 onwards. What's the lasting effects of the dislocation that will both have kind of permanent scars in terms of asset prices, but also in terms of the economic dynamism that characterizes the global economy? So before I do that, I think the easiest way to think about it is take yourself back a decade or 12 years to the global financial crisis and think through what were the big 3 or 4 mega trends, the dislocation that happened as a result of the collapse of Lehman Brothers and so forth, and that stayed with us for basically and characterized most of the 2010s. And I think a very similar analytical exercise applies here to COVID and thinking about what will be with us during the 2020s. And I'd say the first one, if you're just looking at the macro character of the recession. In 2008, we had the housing sector collapse, and that brought down the financial sector. The damage, surprisingly, was not only limited to housing and finance, but it also brought down a large chunk of manufacturing too. What survived, or the crisis fairly intact, were the service industries. And what you then had basically is a macroeconomic shift in terms of from higher productivity and higher wage sectors to slightly lower productivity and lower wage sectors. The labor displacement, we'll talk about that when we get into the US election, hit particularly non-college educated men in the United States, a little bit similar in Europe. And a lot of the new service jobs that were created were lower paying than the manufacturing jobs that, or the housing jobs, the construction jobs that had gotten lost. The second effect in 2008, in terms of global geoeconomics, was that we think of it as the global financial crisis. But if you go to Asia, people will keep on reminding you that it was not a global financial crisis. It was a Western financial crisis, primarily concentrated on the balance sheets of European banks, sovereigns, as well as across the US. The resilience, the Asian resilience led by China in 2008 accelerated kind of the rise of Asia, the rise of China as an adversary and rival vis-a-vis the US, kind of that characterized most of the 2010s. But back then we had China also helping out in bringing the world back with a stimulus support program that kind of was the locomotive of the global economy, particularly triggering a commodity price recovery, even a commodity boom in many cases, that helped emerging markets recover and therefore pulled the rest out. The third factor 10 years ago, and I'm going through this fairly slowly because as I'm speaking, you're probably applying that same lens to the COVID crisis, is the financial market one. Obviously, rates hit zero back then. We all got to learn about quantitative easing, something that I'd only heard about in my graduate economics seminars, an abstract version and a brief chapter of what Japan had done in the 2000s. But we all became masters of QE fairly quickly. But what QE did, the unconventional monetary policy occurred in conjunction with a tight fiscal position, meaning austerity or semi-austerity across Europe and the US, while monetary policy was given free rein. So basically, policy fought only with one lever instead of two. And as a result, from a financial market dynamism, you got a lower productivity, a lower inflation economy, but also a tailwind for risk assets without the inflationary risks that can usually, or corollary of that. So from an investing point of view, it was actually a fairly easy conclusion. You basically pile up the risk curve, whether that's the duration, whether that's you want to risk your credit, equities, and particularly real assets. Now, if you take those three mega trends as the conclusion of the previous crisis, this crisis is quite different. This time we have disruption, particularly in the service sector and those elements of the service sector that have these fairly low-wage jobs. Now, again, we'll have a labor supply overhang, this time not of non-college educated men in the US, it's particularly white men who suffered in 08-09, but of women and various, also from a distribution point of view, a different demographic makeup than previously. The other thing is, to what degree is there a permanent displacement here in terms of relative asset value? If you think about downtown, formerly known as tier one or prime commercial real estate, in the relative value chain, there's a permanent dislocation in the asset values underlying the economy. But the big risk, of course, is the overall shift, the dismantlement of service sector that had been able to absorb large chunks of labor and carry on. In absence of any policy support, this would be an incredibly long and persistent drag on growth. So the real question is, to what degree do we get a policy response that somehow soaks up this excess labor and provides for a restart of the economy? And again, it does link in a little bit to the election later on, but some of it is structural to the degree that the other growing sectors, unfortunately, do not currently offer an outlet. Basically, absent a policy position, regardless, there is no way to absorb that excess labor, which means that unless this labor overhang gets absorbed, the inflationary pressures which could be building will be absent. The global perspective, if last time we thought, oh my God, the 09 crisis accelerated the rise of Asia and China, I think COVID is probably the same effect, perhaps even on steroids. It's not only on steroids because it's a health crisis, but it's the resilience of governance, of strong governance systems in Asia is coming to the fore in a way that is really will have lasting effects. Particularly the obvious one is across global geopolitics and the rivalry between the US and China, which is now accelerating as a result. Back then, if you think about the last decade, we saw a very delayed response until you basically got the blowback, and the blowback came via domestic politics. In this case, it will not come through domestic politics, but it'll be transmit in more the classical fashion. We've seen that the US-China decoupling is on track. There is no way to reverse that or slow it down in many ways. But the big irony is that the risks for investors is not necessarily to US assets or Chinese assets. Ironically, we find both of those markets are so large, have the scale, the depth, the interconnectivity to perform very well across all asset classes. The big risks are to the markets and players, third countries, third country firms that are in the middle that have benefited from the nexus of the conventional old school globalization. And that disruption is both costly, but also provides a set of opportunities that is interesting. If you think in terms of the evolution of the US-China rivalry, the trade wars, that's very much rivalry number 1.0. We've evolved quite a bit from there into the tech space, where we now already obviously have deep fissures and disruptions within narrow segments of technology that affect both US, Chinese, and Chinese firms. And it's now arrived in the arena, which is more the domain where I'm familiar with, which is capital markets. And that capital market disruption is hard to predict, but what it does is it ultimately leads to price distortions because you get distorted capital flows as a result. Again, a mix of opportunity sets and risks carry on. In a paper 2 years ago, we had forecast well into the 2020s that at some point the US would become more Chinese. That was the ultimate conclusion of the US-China story. The first 20, 30 years were characterized by a US effort to make the China more Western or American. That has clearly failed. And now we are going to see the inverse story. And that means a return of the state across all barriers. We thought even absent a pandemic, you would have a US president at some point telling private US companies who to buy and how to buy them. The way, if you think about the president intervening in TikTok and so forth.
Elliot,
yes,
if I may, can I just pause you there and just pose a couple of questions on what you've said so far, because you're covering a lot of ground, and I think it probably would be appropriate to just, many of our people I think would be interested if we could just plumb a little deeper into some of those, if that's okay with you. Firstly, you've spoken about this disconnect between China and the US. How do you see that playing out in terms of other countries filling in the gap, which will emerge as we cut off or slow down or minimize Chinese trade? Which are the countries that are going to be the winners? And more importantly, is there likely to be inflation as a result of cutting off such a low-cost provider as we've had, and starting to substitute either local production or imports from other countries? Clearly, the market has told us that for for a huge amount of stuff we buy as Americans, the cheapest and best producer, on a price to value basis is China. So anything we do other than that is going to kind of be second best in terms of price to value. Do you buy that thesis? And if so, how do you see the US economy and the US consumer being affected by the impact of this disconnect?
Okay, the first question is a little bit more straightforward, which is about the third countries. Who's the winners and losers in this? Well, the winners are, maybe let's focus on the winners. Let's be a little bit more glass half full. The winners are clearly those who are recipients of the reshoring, the rearrangement of supply chains. There's been a lot of talk about that since the trade wars started from 2-3 years ago. Very little has actually moved. If you look at both surveys, if you look at hard investment data, if you look at the foreign investment trackers, very few supply chains have actually moved in practice. But I think my thesis around this, that a lot of that has been because there's been a high degree of uncertainty around future trade relations, not only between China and the US, between the rest of the world and the US as well. Obviously, one potential outcome of the election could be that uncertainty lifts itself. And so therefore you could have beneficiaries around those countries that are obvious reshoring recipients. And that's Mexico, which is the only country to demonstrate until today and material increase in American firms reshoring operations from Asia away towards Mexico. But it's also Central Eastern Europe. And then, of course, big ones are all across emerging markets in Asia. The other winners are those countries, and it's a similar set of countries, to be honest, that enjoy access to cheap funding, either through their own capital markets or because of the credible performance in international bond markets, or and as have access to a large final destination market. So either NAFTA, the EU, or China. And those are the criteria that will characterize the winners. And the losers, conversely, are those or not. Those are EM countries who are very vulnerable to volatile capital flows for funding sources, that do not have an integrated final market at their doorstep. Think of the Turkey, South Africas, where they've kind of been playing this game of sitting at the nexus of these global crossroads, which was great in the era of globalization, less great in the era of US-China confrontation. Which leads me to the other question, which is about inflation, which I didn't get to in my earlier, is you're wondering about supply chain induced inflation. And I think I do not share that concern. I think that's rather misplaced. What you get is kind of a staircase effect in terms of 1 or 2 time or 3 times short singular bursts of inflation as that readjustment happens. And yes, the consumer loses out a little bit in the process, but over time that inflationary effect fades away, because inflation ultimately is the idea that you have an ongoing systemic accelerating price increase. So you do not, that step change would not happen. But let's briefly take, Selvin, if I may, let's go back to one thing we hadn't spoken about, which was the financial market element of the COVID disruption. And inflation is important here because what's different this time from 10 years ago? And I really stress this, it's the biggest difference. We're not only playing with monetary policy, we're playing with fiscal too. And we're not only playing that in the US, we're playing that in all across Europe, we're playing it in Asia, we're playing it in emerging markets. 15 emerging market central banks have engaged in some form of QE. And they're also, for the first time in an EM crisis, doing a fiscal expansion at the same time. If you recall, typically these countries have to tighten belts to attract capital in a crisis. This time they've gotten away with doing the opposite, which is a good thing. That's the big difference. Now, what happens when you only have QE? You don't get inflation. You get asset price inflation because ultimately the money flows, it remains within financial assets. There's a transmission into the real economy, but it gets diluted quite a bit. It's very different if the money printed by the central bank is actually eventually spent. At some point, you do get an enlargement of the monetary base. And as a result, you eventually, from a monetary economics point of view, would get inflation. Now, I say that would because there's a long way till there. And I mentioned in the beginning, you have a big overhang of excess and output gap because you have all this surplus labor lying around. You have all these devastated assets that are worth less, loans that go bad, defaults by borrowers. So you have a lot of problems to deal with until you get into that inflationary phase. But we have the ingredients in 2020s for a comeback of inflation. Not today, not tomorrow, not next year, but in this decade, and frankly, I think you have to have gray hair to even remember what inflation looks like. So your experience may come in handy.
Thank you. Yeah, my hair actually is the residue. Yeah, I do remember inflation. Many of us still do. That's comforting. Of course, the markets are not expecting inflation, hence low interest rates. And if you look at the TIPS pricing, which is the Treasury Inflation Protection Security, which is the kind of the bellwether or the indicator, is telling us that the markets are not expecting inflation. But I wanted your input on why that's the case. And thank you. That's a very coherent and a practical example of listening to smart people, which is why we're so grateful to have you with us. Thank you for that explanation. That is terrific. I continue with your presentation. I have some other questions, but I don't want to take over the show. So continue with what you were saying, Elliot, and then I'll jump in a bit later.
Well, I think let's talk about inflation. Stick a little bit why market pricing right now is. I mean, correctly, it's far off. I think we are typically trained to think about the inflationary gaze. I mean, you mentioned the TIPS market. People look at long-term yields. One consequence of where we are in the policy environment is you've stepped on the pedal with monetary policy. Not only rates are at zero, but you're buying bonds at a rapid clip. As a matter of fact, you could not. The net issuance of treasuries was basically negative for several months in the beginning of the pandemic, meaning the Fed was buying not only more than what the government was issuing, but also just still mopping up a variety of government bonds that were out there in the marketplace. We're still not at elevated levels of net issuance that are reaching, that are being auctioned off at markets and not being swallowed by the Fed balance sheet. Now, what happens in that scenario is that the central bank, and this not only goes for the Fed, they start to build up their own balance sheet problems and balance sheet risks, where at some point, even all things equal, it almost becomes challenging to raise rates again, as they would incur they carry a severe interest rate risk on their own balance sheet. you combine that with a fiscal expansion, which is multi-year, is necessary. There is no question about it. The worst would be austerity. But I want to just draw out what happens over time. A high buildup of government debt, enabled only by very suppressed debt servicing costs as a share of government revenue or a share of the GDP. Interest costs are no higher today than they were 10, 15, 20 years ago. Obviously, that's only possible through the financial engineering of rates and where they are today. The US government finances itself at 0.7 roughly over the 10-year. I didn't check it today, but that's roughly where it should be. Obviously, at that rate, you can sustain incredibly high debt burdens. The problem there is that the sovereign too, is then heavily exposed to moves in interest rates in the future. What it means is you get a straitjacket that the ability to normalize rates becomes very, very difficult. We saw a very soft version of that over the 2010s, where the rate normalization took very long to occur and then happened in a very tepid fashion. I would say this time those constraints are multiple stronger to work off. So what you get is you get a handicap, you get an inflationary or a dovish bias in terms of the policy straitjacket, which means that once you do have inflationary pressures, which are absent and will take a while to arrive, the policy response will be slower. And therefore that reflexive ability to respond will be delayed. And don't take my word for it. Listen to the Fed. I mean, they're the ones who've actually said so. They've said, well, we're going to do average inflation targeting as a result. And they've already announced in August 2020, basically they've signaled that their response in the 2020s, 2-3 years later, will come with a delay. And that, of course, has ripple effects beyond just the direct inflationary dynamics at play, but also think about exchange rates. One of the nice offsets of a reserve currency, particularly the US dollar, is that it does well in a very bad crisis, but it also does well when things are going really well, because global markets anticipate Fed rate increases and therefore price in future rate differentials. That element of US dollar appreciation is likely to come also with a delay or not at all in the future. So you get a very different financial market dynamic as a result of policy decisions taken today have an effect multiple years later. So I just want to set the stage for if we do talk about policy and what would change policy. Decisions made today do have bind successors into the future in a paradoxical manner. I don't know whether that's a point to talk about the U.S. election or not.
Yeah, thank you. That is great. Thank you so much. I just, if I can, I want to take it just I want to backtrack a little bit. You started off by, I think, very sagely looking back at the global financial crisis, which you, I think, interestingly recharacterize as not so global, which is very interesting insight, actually. Thank you. But you kind of reviewed that relative to where we might be looking at going from now in terms of the lens that you put on then. How does that apply? Can you do the exercise you challenged us to do as you were speaking? Can you take us through the kind of mega trends that you think will continue post-COVID, and possibly even, if I can allude to that, possibly post-election, in terms of where do you see things with the backdrop of COVID and where we are there, and the eve of the elections where we are, and using the lens of prior somewhat similar situations? Of course, nothing similar, as we know, everything's different, but there are some, as you correctly said, I think some big similarities. Can you take us through a possible scenario as to how the future looks? What are the mega trends that will remain after the two events we're facing?
Well, some we already touched upon. One is that the decade has the potential to see inflation return in a way that was really not absent for the last 10, 15, 20 years. And you mentioned supply chain disruption as an inflationary pressure, but there's other mega trends that are now being accelerated. So you have kind of what we call deglobalization or the decoupling. That's going to obviously raise costs not only for the one-time disruption, but the reshoring and ongoing. But then you also have the demographic inflection. China is no longer adding people to its workforce. It's shrinking. That shift from kind of savings accumulation to decumulation as a large chunk of the global population, not only in the West, the baby boomers, but also in China, starts to tap into their savings to finance their retirement. That too will kind of upset or stop some of the deflationary forces we had for many times. And then finally, of course, central bank independence. I already talked about it. Even in the benign scenario of well-behaved governments, there's a bit of a straitjacket imposed by the decisions made in this crisis that will kind of bind or constrain the central banks to be as independent as in the past. If you add on top kind of government willingness to interfere and actively dictate, you get it even more. So that erosion of central bank independence together means once we get over the hump, there's a real potential for inflation, which there hadn't been in the past. The second trend we talked about, which is an accelerated rivalry of US-China, not only the technology decoupling, a trade relationship that gradually simmers and is less intense, but one that spills over into capital markets. So there too, really the creation of two parallel worlds that very, very, very slowly, which will ultimately drag in suppliers, partner countries, and eventually currencies. And then, but the macroeconomic ones are harder. The only thing we know is large chunks of the service sector are damaged. The manufacturing sector is fine. What do you do with that damaged part of the sector? We've had chronically low productivity, chronically low growth over the last 10, 20 years because we already had problems dealing with the technology disruptions of what do we do with these displaced workers. And mind you, the displaced workers, it's not just one of a good factory job with the classic American dream. Those were industries with higher productivity and higher growth rates overall. So when you rotate that out into like a low precarious kind of the freelance industry, the service sector jobs of waiting tables, hotels, all of these are much more fragile. If you do nothing, it's a policy choice. And that's what the election to some degree does matter. It's a policy choice. What do you do with this labor overhang? You want to channel it into higher productivity areas of the economy. And that can only be done with public investment. It's very hard to do it organically in the era of global markets. Governments would have to deliver some type of push to do so. Otherwise, you get that continued trend towards even lower trend growth, lower potential growth, and kind of a dabbling in productivity. Now, in my view, I believe, and this is not only a US question, it's about Europe, it's about emerging markets too, it's around Asia. I believe in many cases, governments are going to make the choice and do what they haven't done in a long time, which is actually spend money in areas that should deliver a little bit more productivity than in the past. So not only, we talk about stimulus packages. We haven't seen stimulus package this year. We've seen rescue packages, kind of tiding over households and businesses. That's not a stimulus. I'm still looking forward to a real stimulus package anywhere in the developed world. And but that is the key variable. If it doesn't come, then you eventually get, you get higher deficits, low growth, and eventually inflation, and you get a lot of political turmoil because you have a lot of unhappy, struggling people across your society. An alternative, happier scenario is public investment flows into high productivity areas, and the inflationary forces are kind of digested in a healthy manner and gradually, and we kind of exit this on a path to higher growth. Obviously, probably the truth is somewhere in the middle, but that is fundamentally the choice of today.
Thank you. Can I just put you on the spot with a couple of key questions? If you can just do a potpourri on responding to the following. Number one, this inflation of asset prices. What do you think about equity markets and valuations at the current time? If we can ask you to put on your prophetic hat. And secondly, how do you see the role of gold and what it might do in this situation. And then we'll save one more for the end.
Well, I'm a macro guy, so I'm probably not best placed to talk about equities. But the reality is, where are we we just went through a bad recession. We're not out of it yet. There's probably still some good news coming. A lot of it has been priced in, not everything. And the pandemic, unless there's a mutation in the virus, should get better. There should be, call it stimulus, public spending in the US should be more forthcoming, similar in Europe. And eventually there'll be some normalization. So there's probably a little bit, I know valuations are high. I do not think they're unjustifiably high. We're still very moderately, very cautiously bullish overall because we think fundamentally we're still in a recovery phase. Although it is subject to some critical decisions that have to be made right now. On gold, let's talk about just safe haven alternatives in general. I think will do well, and that's because we're in a weaker dollar cycle. There's nothing bad about that. Dollar cycles last many years. We just took a turn over the past year, now into a weaker dollar cycle, which will probably last for several years. During weaker dollar cycles, the gold tends to perform a little bit better as an alternative globally. You add in the geopolitical dimension. Central banks were net buyers of gold the last 5-7 years, but actually when you look down at the data, it's really just 3 central banks, or 4. It's China, Iran, Russia, Kazakhstan, and I think you all can fill in the blanks what the motivations were for these central banks to be buying gold. Well, some of that that appeal will still last. There are still a lot of actors in the world that want to escape the US dollar network, and gold attracts that. And frankly, in terms of volume, there's still quite a bit to do. I think maybe on the topic of gold selling, maybe let's pivot the discussion to really long-term trends, and that's the shift towards digital money overall, because that I think will have a big impact on the price of gold as well, because there will be alternative safe havens or assets that some of these flows can go into.
Okay, and any idea of where that might go? In other words, to put it crudely, what's the future of Bitcoin, and is it a smart investment?
Well, we don't trust Bitcoin as a financial asset. We do not think it performs as well as gold. If you want to have an alternative to basically fiat currency, we think gold functions well. It's a very well-established marketplace for that. That's just our house view. We don't have any Bitcoin products that we sell, and I wouldn't endorse them. I do find one thing very ironic about Bitcoin, which is the libertarian appeal of Bitcoin, kind of to evade the constraints or trappings of government money, is that government money is about to change, and it's going to use the technology that Bitcoin uses. The renminbi there's basically a beta version, a prototype of a digital renminbi. The ECB has worked on a digital euro. The Fed is looking into a digital dollar, although is I think several years behind the others. Once that government money comes on board, that will really have incredible potential to dislocate the way we think about financial markets, the way we think about the financial sector, the way we think about global capital flows. And so I'm watching that space closely because the potential for disruption is enormous. I know it's an it seems like an off-the-radar topic, but one should really think about, I know we don't spend time the same way I never think about how a toilet actually works. We never think about how our financial system works when you kind of open the hood. But currently, the way credit is created and the way central banks kind of backstop the banking system, and then that kind of extends credit and holds deposits. Well, that entire edifice has the potential to change if you create a digital government money that runs on a ledger system, and where the central bank basically could allocate both credit and deposits directly to households and businesses either by choice through the banking system or directly bypassing the banking system. It could also mean big things for cross-border capital flows and capital allocation. If you do not need your bank to actually, and not only talking about money payments, but actually for capital allocation cross-border in terms of currency. So that's a huge potential. I think that has really revolutionary potential, much more so than Bitcoin, which I think in a few years may become a very niche product, so to speak.
Great. Before we leave gold, I must tell you that in South Africa, when I did my postgraduate studies, I wrote a white paper which basically had the subtitle, "In South Africa, they dig gold out of the deep mines in the Johannesburg area. They bring that ore up to the surface, smelt it, refine it, melt it into bars, and fly it to the United States, where at Fort Knox it goes back deep under the ground into safekeeping. What has been achieved by this exercise?" And I will leave everyone with that question. But I do want to end with, if I can, just one I think substantive and timely question, which is, I think we know that if Trump wins the election, we'll have more of the same. The question is, what do you see as the mega trends that will change if a Biden administration takes over? What do you see as the big changes? And by the way, do you agree with the first part of my question?
I think I do agree. And frankly, I agree largely because I take people at their word. I looked at the 2020 campaign manifesto, and there's not much new in there. It's a status quo manifesto. So I think they've, in the first term, Trump has kind of lived up to a lot of his campaign promises that he campaigned on in 2016. So I trust him that he's probably going to live up to the status quo promise that he's putting out there right now if he does get reelected. I think from an economist point of view, I think I had a big hope after the last election, which was, you also saw it in financial markets. You saw the bond market, the steepening of the yield curve very quickly after the election. The idea that the reflation was going to happen, you would actually get a real bounce in growth in the U.S. And particularly the tax reform was an opportunity. And the hope for economists like myself was, okay, great, you'll get a corporate tax cut. Some of that may flow into CapEx. You'll get a jump start in investment, and you'll get a boost in productivity, and kind of good things will flow from that. That did not happen. Let's be very frank. The first part happened, but the consequences did not. And that was the disappointment. I think the one hope I have again, and maybe I shouldn't be too foolish and naive, is that maybe this election will deliver that finally. Maybe we'll get somehow, okay, not through the private investment. It failed to deliver the private investment bounce through the tax cuts. Maybe you'll get the public investment bounce. We've had infrastructure weak for 4 years, but no infrastructure being built. Maybe you'll get an infrastructure push in the US that's meaningful in areas where it matters. So obviously in areas that are growth enhancing, in areas where GDP is concentrated, in areas where you have a big underinvestment in either physical or human capital, where investment really can make a difference. And then you get a genuine reflation that is healthy and positive, that lifts growth and is sustainable. I just want to draw attention to the fiscal multiplier. I'm a big believer in public investment. I grew up in Germany originally, where public investment is very low, and I scold the Germans all the time that $1 of public investment is worth more just from a GDP perspective than $1 of tax cuts, because has a higher multiplier effect. Now, $1 of public spending that just goes towards household support does not have that effect. It's been basically a decade of no public investment of any meaningful form. So that's my naive hope that we'll get that after the election. I think to some degree that's also on the ballot. Do you want public investment, yes or no?
Elliot and Dr. Hentov and the State Street team, really, thank you very, very much. It was quite gratifying to hear your perspective as someone not only who lives in the UK, but does these all day, every day with audiences and partners around the world. So your insight, your global insight and perspective, it was very much appreciated. Thank you very, very much, Elliot. Also, just really proud of our affiliation with State Street and the fact that we have you and your team available to us as a thought partner to help service our clients also around the world. So thank you very, very much. With that, I think we'll wrap it up and say thank you for a great and informative discussion. And we'll be in close contact with both our advisors and, of course, our clients over the next month, because I think this dialogue will be quite dynamic. So thank you.